What if leaving money exactly where it is earns you a tax deduction without paying a single zloty of interest to anyone? That is exactly what a quiet provision in the Polish corporate income tax law lets you do. It is called hypothetical interest on retained profit, and at least according to my experience, a lot of company owners have never used it simply because nobody told them it exists. Today I will show you what it says in essence and walk you through a real example using this year's actual applicable interest rates. Hi, my name is Michał and I am a Polish licensed tax advisor, and I provide accounting, cost calculation, tax compliance and tax advisory services for small and medium-sized enterprises in Poland. Today's topic is the Article 15CB of the Polish corporate income tax law. It rewards companies for keeping profit inside the business instead of paying it out by letting you deduct a hypothetical interest cost calculated as if that retained profit had actually been borrowed. By the end of this video, you will know how it is calculated. Here's the plain language version. Normally, if your company borrowed money from a bank, the interest paid on that loan would be tax deductible cost. But if you fund the business with its own profit instead of debt, there is no interest, so there's actually nothing to deduct. The Polish Corporate Income Tax Act says if shareholders formally decide to leave a year's profit inside the company, so they're transferring that profit into the company's reserve capital rather than paying it out as a dividend, the company is allowed to calculate hypothetical interest amount on that sum and recognize it as tax deductible cost, exactly as if real interest on a loan would be paid. So no cash actually moves because there is no interest that is being actually paid, but the deduction for corporate income tax purposes is real. The same mechanism may also apply to some forms of cash contributions shareholders make to a company. But today, let's focus on the more common case, namely where the profit is simply kept in the company. Here's where people get usually tripped up, so let's be precise. The rate you apply isn't something you pick up, it's the National Bank of Poland's reference rate as it stood on the last working day of the year before the tax year you are claiming the deduction in. Add 1 percentage point to that and that's your rate. And this matters. The rate isn't locked in once and reused for years. It's redetermined every single year based on that year's own starting point. We'll see exactly in the example what that means. And you don't get this deduction only once. You get it for 3 tax years in a row. The year in which the shareholders make the decision to leave the profit in the company, plus the 2 years after that. Same retained amount, 3 separate calculations, because the rate resets every year. There is a ceiling though, across everything you claim under this provision in a single tax year, every retained profit allocation, every qualified shareholder contribution, the total cannot exceed 250,000 zloty of deductible cost. For most small and mid-sized companies, this ceiling won't bind, but for a company retaining several million zloty, it will. Now the part that keeps this honest. If you take that retained profit back out, you pay it as a dividend or return a contribution before 3 full years have passed, counted from the end of the tax year when the decision was made to retain the profit, the discussed tax deduction gets reversed. Whatever was deducted as hypothetical interest gets added back as taxable income in full in the year you pay it out. So this isn't a loophole for parking money for 6 months and pulling it straight back out. It's a genuine reward for actually leaving capital in the business for the medium term. Okay, so let this make more concrete. Let's say your company closes the year 2020 2025 with a net profit of 1.1 million zloty. Polish law gives shareholders up to 6 months after year end to hold the meeting that decides what happens to it. So by the end of June 2026, the shareholders of the company pass a resolution. The full 1.1 million zloty generated in the year 2025 remains in the company. It goes into the company's reserve capital. No dividend, it stays in the business. And because that decision was made in the year 2026, your first hypothetical interest deduction lands in the tax year 2026. The company will be entitled to recognize this hypothetical interest already in the calculation of the advance payment for the corporate income tax for the month in which the shareholders made the decision to leave the profit in the company. And then the rate you use is the National Bank of Poland's reference rate as it stood on the last working day of 2025, the year right before. As of the end of 2025, the rate was 4%. Add the 1% point uplift and you're at 5%. Apply that to the 1.1 billion zloty that were retained, and the result of that is 55,000 zloty. That's the amount of the hypothetical interest, a real deductible cost well under the 250,000 zloty ceiling for money that never left the company and never generated a single real interest payment. At the standard rate of 19%, that 55,000 zloty deduction is worth 10,450 zloty of actual tax saved. On the other hand, if your company qualifies as a small taxpayer who is paying corporate income tax at the rate of 9%, it's 4,950 zloty. And you are not done. The same 1.1 million zloty of profit generated in the year 2025 and retained in the company based on the shareholder decision made in 2026 qualifies again in 2027 using whatever NBP's reference rate is at the end of 2026 and again in 2028 using the rate at the end of 2027. 3 years, 3 separate calculations, all from one resolution. And the only thing you actually have to do is not touch that money until 3 years have passed from the end of 2026. That takes you through to the end of 2029. Distribute it any earlier and you're paying back what you deducted. And of course, due to the fact that this video is being recorded in August 2026, we are not able to calculate the exact amount of hypothetical interest for the year 2027 or 2028, because in order to do it, we need the NBP's reference rates valid at the end of the year 2026 and 2027. But we see that simply because of leaving the profit for 2025 based on decision made in 2026, we might save several thousands or even tens of thousands of zloty on corporate income tax, of course, depending on the applicable corporate income tax rate in the given case. And additionally, also, if we would carry forward this example and assume that there was again profit generated in the year 2026, and if this profit would, based on the decision of shareholders made in 2027, be again retained in the company, then in the year 2027, the company would not only be entitled to calculate and deduct hypothetical interest on profit from 2025 retained in the company in 2026, but this company would also be allowed to calculate and deduct hypothetical interest on profit from 2026 that, based on a shareholder resolution made in 2027, was retained in the company, and so on and so forth with respect to the profits made in the years 2027 and 2028 paid and in the later years. The provisions regarding deduction of hypothetical interest for corporate income tax purposes, in my opinion, suit companies that are going to retain profit anyway because they are reinvesting, building reserves, or for any other potential reason do not draw cash out. So if that's already your plan, turn the decision you were making regardless into a genuine no-cost tax deduction. It's not a reason to retain profit you actually need personally. The mentioned 3-year hold period may make that an expensive way to access your own money. Okay, everyone, thank you very much for watching. As you see from this video, sometimes the best tax move is simply not moving the money. I hope that thanks to the information in this video, you will be able to generate some tax savings in your company, and I will see you in the next one.